For the first time ever, gold has closed a month above $2,000, and this is huge news for the stacking community. And I don't mean this in a hyperbolic way. Many of us have followed a gold and silver stacking strategy that has gotten us to where we are today. As you've heard me preach, as the conditions change, you as the investor have to change with this new information. Take a look at this chart of monthly gold prices since 2014. Believe it or not, from a technical perspective, this is an absolutely beautiful chart pattern. And it's for a number of reasons. First, I want you to notice a significant price run up since August of 2018. While I'll stop short of calling it a sprint from 1200 to 1968, this was a significant price movement over a 2-year period. It was actually a more than 60% increase. Second, I want you to look at 2020 through today as a 3-year consolidation period. Now, I'm fully aware you might refer to this as a period of torture with all the false breakouts that we had to endure, but regardless of how you view it, the last 3 years, it was the needed break gold had to take in order to recharge its energy, so to speak, in order to break through the final 2 barriers. One being closing a month above $2,000, and the second will be closing above $2,064 in a day. That one's still coming. I know this hasn't been fun in games as we've had to endure $200 and $300 price swings, which undoubtedly you look back now as great buying opportunities. As the saying goes, if you can't handle my lows, you don't deserve my highs. The final thing I want to point out about this chart is that October low last year, and these lows around $1,600 were about shaking out the weak hands. So where does this close above $2,000 a month really mean for us? A whole lot. But that's not where we're going to focus on. We need to focus on what we need to do right here, right now, as the inevitable for the all-time high prices now seems to be imminent. Okay, before you get too excited, I want to warn you, these markets are fickle little beasts and they can turn on us at any minute, especially because record gold prices is the last thing the powers that be want to see. So expect them to use every tool in their arsenal in an attempt to slow down or derail this train. Choo choo. Okay, I just had to do that once. At any rate, this includes using the guise of end-of-year tax loss selling as justification for weaker prices over the short term. That's totally cool because we will simply use that as an opportunity to buy more at lower prices, which is the real point of this video. We have endured a very long, slow, and bumpy uphill train ride in order to be right here, right now. But the stacking strategy we've used to get us here is not necessarily the same approach we should use in this next phase of our stacking journey. In some ways, that Albert Einstein quote actually applies here. His words were, "We cannot solve our problems with the same thinking that we use to create them." And I submit to you that we cannot stack with the same strategy when the conditions that started our stacking journey have changed. Now, don't get me wrong. We still have all the same problems. None of those have improved. But what has changed is the realization by others and soon the masses that gold and silver are some of the best ways to protect your wealth and your quality of life. Think back to a few months ago when silver premium skyrocketed to almost 100% of spot price because of shortages and increased buying. Our stacking strategies had to shift because of what was happening. That same kind of shift is about to happen again, and we need a new stacking strategy for 2024 and beyond. Because what you do and buy during a bull market changes in a few key ways. Before I get into those, real quick, I got a lot of y'all that watch, and I appreciate the love and support, but I need a lot more of y'all to subscribe. More than 80% of y'all watch, but don't subscribe, so go ahead and do me a favor. Hit that like button, and while you're hitting that like button, go ahead and hit that subscribe button. Also, shout out to my boy Constitutional Stacker. I'm gonna have a link in the description of a little quick little video we did. We got to meet up over the holiday break. It's just a short 4-minute video, but go check him out. Great dude. Much love to you, Constitutional Stacker. Now, back to our topic here. First, the first key change is we have to start with our mentality. If you've been around for a while, this shouldn't surprise you. That aside, many of us start stacking as a way to protect our buying power or as a hedge against inflation or as insurance or extra savings, just to name a few of the reasons. However, when you are in a bull market, you can't have a defensive or deficit mindset. When in a bull market, you have to think and act like a bull. Not bullish, but like a full-on bull. If you're lucky, you'll experience 3 of these kind of markets in your lifetime, and they present you with a chance for our pet rock or our barbarous relic, as some people call it, to create opportunities for us to dramatically change the quality of our lives. So let's start by seeing this as a wealth-building opportunity that is just waiting for you to go out there and claim it. That does require you to know what you're looking for, where to find it, and follow the habits that will make it happen for you. We will have to save that for another video though. Second, even though gold and silver prices will be increasing, that doesn't mean we won't have some challenges, especially financial challenges. because it's only a matter of time before the next wave of inflation rears its head again. We will start to see this once the Fed begins cutting rates. Regardless, the second key habit and possible shift is that you have to make your stacking your habit by paying yourself first. We all are going to experience increased demands on our budgets, but your stacking cannot be something that you do after the fact or with whatever you have left. If you do this, your stacking budget is likely going to suffer. Invest first and live on whatever you have left. The old adage is true. We will spend to whatever level we have available. When most people get a raise, they don't take that increase and simply save it. No, they increase their spending to include their new raise. Lastly, while we talked about this a dozen times in preparation for this moment, but you have got to have your personal budget and balance in order. I have a new rule for you. You can't complain about the US government budget spending and deficits if your budget ain't right. Step number 3 in this strategy, it's about choices, or more simply put, what are you going to choose to stack? If you're a follower of Stackers University, then you already know this, but unless the price difference is really close, generics and gold bars are the best way to go. The time for the BS, boutique silver, and sovereign coins was when the metal prices were numerically cheap and or premiums were low and almost the same price as generics. But remember how I referenced the spike in premiums for silver eagles a while back? What do you think will happen when Joe Public starts buying? They will buy all of those coins because they don't know any better. They will think that because it's minted by the US government, that is somehow better. No. Joe Public is going to drive prices and premiums higher on all the quote name brand coins. And you know what I'm going to do? I'm going to be selling every sovereign that I have that I can to get me more ounces, because this game is a game of ounces after all, folks. So if trading 4 or 5 eagles gets me 5 or 6 generics, consider it sold. I know this isn't popular in the stacking community, but I'm an investor first, stacker second, and the math is what drives my decision making. You do you, boo-boo. By the way, do y'all remember a year ago when I did that video where I traded 270 ounces of silver for 3¼ ounces of gold, and some of y'all thought I was crazy? Let me remind you, I did this when silver was around $21 or so, and gold is around $17.20. Well, I bought those 300 ounces back for about $22, but the gold is now $300 more per ounce, and the silver is only $3 more per ounce. That is why we let math drive our decision making. That particular move worked because of strategy and math. The fourth strategy is what I refer to as the stacking dilemma. And I've mentioned this before, but 1950, 1900 gold isn't very attractive for me to buy because I had such a low dollar cost average. I've documented this on this channel, but you know I'm quick to sit out the market, stack cash, and wait for strong pullbacks to really load up on those lows. The challenge we all will now face is how do we keep buying at these higher prices when all it does is drive our dollar cost average up? I think we have to remind ourselves that these prices might be the lowest we will ever see in our lifetime going forward, which is going to very easily feel like you're chasing price, which is hard, and I acknowledge that. Another option is separating out your purchases and keeping them in a separate tab in your spreadsheet. At least that way you can say, pre-run up and post-run up. I know it's psychological, but every little bit helps. Or just come to terms with this being a part of the game and try to buy on pullbacks and accumulate as intelligently as possible. Not stacking isn't a viable option. Remember, we've covered Elliott wave theory here before. Things don't go straight up. If they do, they tend to come straight back down. Prices move up and they retrace back, which then become your stronger buying opportunities. You're going to need to use that to help you get the most metal for your money. The fifth and final strategy is about how you transition and grow, specifically transitioning from a stacker to an investor. In an uptrending or bull market, you just can't keep up with the price increases by using your own money to grow your stack. For me, the answer is moving from a stacker to an owner, which means using assets that are leveraged to the price of gold and silver. Yep, I'm talking about mining stocks again. I've documented this in other videos before, but the amount of profits I've made percentage-wise, gold will have to be close to $2,300 an ounce. You can't keep up with the price increases if you don't have leverage in these kind of environments. That's why the mining stocks are going to be so valuable in growing your wealth. And this example I gave you was just moves off of the bottom. These aren't even the real moves that come when the bull market really gets going. I'll cover this in greater detail in future videos, but this doesn't require you to go out and start buying explorers. The mining sector is so cheap right now that just investing in the big boys or the GDX will provide you with more than enough leverage to help you keep up with the price increases. If nothing else, you can take the profits from the mining stocks and use that to offset your physical purchases. Just food for thought. In the comments section, do you think your stacking strategy will change as prices increase? Are there any other topics you'd like for me to cover? Or simply put an A+ in the comments section so that everyone knows that you always stack smarter and never stop learning.